What's changed from you and your calls for the Federal Reserve based on what happened on Friday?
Sure. We were in the 50 basis point cut camp for November. The data dictates that that is no longer necessary. So we now think that they'll go 25 and that they'll deliver a string of 25 basis point rate cuts until they get to March of next year, so around 4%. And then they'll slow down to a quarterly pace of cuts until they get to a trough of 3 to 3.25. At least that's the base case. Now, I'll tell you that amongst our clients, there's a lot of uncertainty out there right now. The data has surprised. It doesn't seem like the data is giving us a particularly clear narrative on what's going to happen. And we sense that investors are really shifting probabilities of what the most likely economic outcome is. There was a lot of belief that we were headed to a soft landing with elevated risks of a recession, or at least increasing risks of a recession. Now, soft landing is still the base case, it seems, but the market is putting a little bit more weight on the possibility that maybe there's a quote-unquote no landing type scenario, or maybe the Fed doesn't need to cut much below 4% at all. And so the market right now, we think, given that uncertainty, is just trying to be a bit defensive. Rates clients don't want to extend too far out the curve right now, especially given that we're just about a month away from the election. And as a result of that, they're keeping things nimble and light and kind of waiting for data to try and guide a bit more.
We saw money pile into money market funds as well ahead of that economic data. And I've asked this a few times. What do you think is behind that move? What's driving that?
Rates are still high. And just because the Fed is cutting doesn't necessarily change your behavior as a depositor. Ask yourself, what does your retail bank deposit pay you? If it pays you something close to T-bill yield, you should tell me where you bank, because I'd be interested in knowing that. But for most retail depositors, they're offered something close to zero. And so T-bill rates are still well above that. And so we do think that there's going to continue to be a lot of inflows into money market mutual funds, even if the Fed is cutting. Because it's not about whether rates are rising or falling, it's about the overall level of interest rates. And work that we have done says that you shouldn't expect to see really large outflows from money funds unless the Fed cuts to something that is at or below 2%. And that seems very unlikely based upon the data that we have at hand and what the market is thinking about the Fed cutting cycle.
We've talked a lot about the front end. You've talked about how that money in money market funds could be quite sticky unless Fed funds comes down to something like 2. Can we talk about the long end and just finish there?
Sure.
What are you looking for at the long end of the curve? What kind of numbers? We had a guest from PGIM yesterday saying we're in the buy zone, 4% to 4.25, lock it in. Get a second bite, a second opportunity, take it. What's your advice?
Yeah, so we wrote yesterday that we do think, at least using the 10-year as a proxy, between 4 to 4.25 is a reasonable place to begin scaling in. We're already there, obviously. But here's the framework that we have used. And a number of folks on our team have recently written about this in slightly different ways, but we call it a 2-3-4 type framework. The Fed is almost certainly going to cut to 4%, almost regardless of the data. Don't believe me, look at their dots. In 2025, all dots except one are below 4%. So that seems to be the recalibration zone, and that's maybe consistent with quote-unquote no landing. And so if the economy performs really well, then 4% is probably where they'll end up. In a soft landing scenario, using the Fed's own baseline, they'll probably end up closer to 3%. That's the BofA house view. That's our economists' view as well. And if there's a recession or some type of sharp slowdown, then you can envision a 2% or lower type of outcome. So then the question is really, how do you assign probabilities to those various outcomes? And again, our base case is the soft landing. That's all well and good. But if you just look at 10-year OIS, let's say, and that's around 360 at the moment, if that gets up to 375 or even higher, then clearly the market is overweighting that 4% outcome, that so-called no landing outcome. And investors can decide for themselves whether or not they think that's reasonable. We think that's very optimistic. And the world's a very uncertain place. The rest of the world is maybe not as robust as the U.S. is. And so to think that we could slip into a soft landing or a potentially harder landing is not unreasonable. And again, U.S. rates and fixed income provide a hedge against those outcomes. And therefore, we do think that if 10-year OIS gets to 375, again, be thinking the 10-year close to 415, 425 at that point, we do think that it's a very reasonable opportunity to begin to scale in and trust that it should perform at some point, or at least that your downside is very limited if you're investing around those levels.